Hey guys, and welcome to Relentless Growth. I talk about real estate a decent chunk of the time on this channel, and I wanted to share with you how I evaluate properties. I use this for my first rental property and the home I currently live in, which I also expect to cash flow generously once I move out. Please note that this is for long-term rentals, not vacation rentals. I'll be trying to over-explain instead of under-explaining. So, if this isn't your first time considering buying a home, you might want to set the video to play double speed. First, does the home work for you personally? I recommend you buy local to where you intend to live, and that the home works for your living conditions. How far is it from work or school? Just trust Google Maps on that one. For me, I hate having more than a 15-minute commute if I can help it. So if it's more than 30 minutes away from anywhere I plan to go regularly, I'm generally not going to buy it. Let's run through a sample property in a town that I'm considering moving to north of Los Angeles. You can follow along on this property or check all of the same data for a property in your area that interests you. First, we'll be starting with Zillow. Zillow is kind of like Wikipedia. It's not the best source, but it's usually good enough if you aren't doing anything complicated. To avoid giving away too much personal info, this works for my commute to most places I'd care to go to regularly. The one exception is that there seems to be no martial arts classes within 45 minutes, but I can always open my own club to fix that. It's a multi-unit property, which I've always wanted. That's because the price to rent ratios can often work out to you living for free when you live in a unit, and you can still get residential financing for a home of up to 4 units. And this one has 4 units, 2 2-bedroom and 2 1-bedroom. I live by myself, so the 2-bedroom would be enough for me, and maybe the 1-bedroom if there's a garage. Most 1-bedroom units, though, will not have a garage. Let's scan the Zillow page and pictures for anything that just leaps out at us. The pictures make it pretty clear that there's no garage, which means I would definitely use one of the 2-bedroom units to live in, and that will become important later. Scanning the text of the Zillow entry. The place was built in 1964, so it's pretty old. So I think I'm running the risk of things like bad insulation. It's been on the market for 55 days. This is a new town that I might be moving to, so I'm not really acquainted with the area. Where I've lived previously, being on the market for more than a month is kind of weird. So that tells me that the seller might be very motivated to offload the place, which means I can negotiate hard. Or there's something terribly wrong with the place that we don't know about yet. All investing comes with risks. A few things stand out to me under the home value section of Zillow. While this estimate is around a list price of $500,000, this place has never been valued at more than $175,000 in the past decade. And the last sell was for only $80,000 in 2020. It's extremely unlikely that the home's value or the local market have grown 5 times in the past 3 or so years, and the owner paid far less for the place than what they're asking for. Typically, the sell price on Zillow is what the seller received in that transaction. So if the place was beat up, the seller may have received $80,000 from the buyer, but the buyer, who's the current owner that I might buy from, could have financed $200,000 against the property for massive renovations, like converting one large house into 4 smaller units. That's the case with the first rental I bought in Florida. Zillow says it sold for $229,000, but I financed $250,000 against it for renovations. So a new prospective buyer might think I paid less than I actually did. Zillow is actually really terrible at making comps, which is what we'll do next. But the Zillow comps do imply that this place is way overpriced. It's possible that the seller is in no hurry to sell, so they have a ridiculous price and are waiting for someone to make a generous offer. Looking at the public tax history, Zillow says the taxes are $1,683 annually, which will round up to $1,700 and use later. I always calculate my own principal, interest, taxes, and insurance. We see here that Zillow somehow thinks the annual taxes are $1,700, but the monthly taxes are $525. That doesn't make any sense. If their monthly count is accurate, then their annual tax cost would be about $6,500. I'll note their home insurance estimate is $175 a month though, if their annual estimate is correct. Please disregard the rent estimate for most properties, but especially multi-unit properties on Zillow. This is not designed to account for the building having 4 units. Alright, that's the extent of what we'll get about this property from Zillow. So what have we learned from the Zillow review? The home may be overvalued, the home is in a slow market or has something major wrong with it. It's a very old building, major renovations likely took place in the past 3-ish years. The seller is either very motivated or very patient, the tax cost is unknown, and the rent is unknown. We'll come back to Zillow for some other info later, but for now let's calculate how much we expect this property to cost us. Cost to own. Unlike real math, where 50 cents rounds up to $1 for real estate investing, I always like to round against myself. So if it costs me money, I round up. If it makes me money, I round down. The idea is that this will account for any unexpected issues. We'll calculate your monthly cost to own and initial cost to own. Open up a tab, go to Google, and search mortgage calculator. When you see the built-in Google tool, click to include taxes and fees. We're now going to populate this calculator so you know what the property will cost you. First, let's assume the home price that we will pay matches the list price, even though we'll likely try to pay less. The calculator assumes a 20% down payment. Contrary to popular belief, you can often get a mortgage with a 5% or smaller down payment. If it's your first time, let's assume you pay 0% down. Note that you will still need 1.5% earnest money. Earnest money is money that you give the seller after they accept your offer to prove that you can and will execute the transaction. Your realtor should ensure that the paperwork ensures that if the deal bottoms out or when the transaction concludes, you get this money back. In this case, your earnest money would be $7,500, assuming some money for transaction fees, inspections, and the like. You're going to need about $10,000 for this transaction. Now, you should always get a 30-year fixed rate mortgage, and you should never get a variable rate mortgage. If people got variable rate mortgages 4 years ago, they are going bankrupt right now. I know that some would argue that you want to pay off the house sooner, fine, but if you get the 30-year mortgage instead of a 15-year mortgage, nothing stops you from making additional payments. It's just that your mandatory payment is smaller. Alright, let's open another tab to check what your interest rate will likely be. Interest rates. Put the bank rate link from the description below into this new tab. You can also use this as an alternative mortgage calculator, but for this demonstration we're mostly interested in using it to try to get interest rates for homes in that area. This calculator pretends you can get a $0 down mortgage. For conventional mortgages, usually 5% down is the minimum, but in many areas you can find a lender who will finance your down payment as part of the mortgage. This does make the loan more expensive though, hence why we'll be rounding numbers against ourselves. So we'll falsely tell this calculator that we'll make a 5% down payment. If you don't know your credit score, then most any credit card account should show you on their app or website what your score is. If you have no credit card, you should get one, and I recommend the Citi Double Cash card as your first credit card. In this case, I'm assuming a very poor credit score, so that the interest rates we get are kind of a worst case scenario. And we end up with what we'll call a 9% APR. Shit, that's high. Thankfully, I bought all of my current properties when interest rates were like a third of what they are now. Moving on and back to the mortgage calculator. Remember earlier when the property taxes on Zillow were inconsistent, being anywhere from $1,700 to $6,500 per year? Let's assume the worst case scenario for this example. Open up another tab and we'll get a home insurance estimate. In this case, the Google mortgage calculator auto-populates $1,750 as the annual insurance cost. Zillow said $175 a month, which would work out to $2,100 annually. Put in the NerdWallet link from the description down below and plug in the zip code of your property of interest. This gives us the average for that zip code of about 1,300 annually. Given that this is a large 4-unit building, this makes sense as a sanity check that our insurance would be higher than the average. So we can assume our worst case scenario of 2,100 annually in our calculator. Next, we have private mortgage insurance. A lot of people think you pay PMI if you made less than a 20% down payment. This is not true. If your lender is competent, they won't try to charge you PMI unless you owe against the property more than 80% of the home's value. However, in this case, since we are assuming we pay the list price of $500K and make no down payment, let's keep Google's automated PMI calculation. This brings our total cost to own to about $5,200 a month. Remember, we've been rounding against ourselves the whole time, so this is very much a worst case scenario, and I'd actually expect it to work out to be a little cheaper. There was no homeowners association or co-op listed on the Zillow page, but this is something we can ask our realtor and the seller about later. Rental comparisons. Remember when I said Zillow's really bad at giving you rental comps? Yeah, so now we're going to do that manually ourselves because Zillow can't just do that. Now we are going to look for comparable rentals. We have 4 potential rental units, 2 2-bedroom and 1 bath, and 2 1-bedroom, 1 bath. Let's go back to Zillow, close the individual addresses page, and take a look at the map. You can clearly see towards the bottom right a cluster of homes around the one we are considering. So draw a boundary around that area and filter results for 2-bedroom properties listed for rent. In this case, we have 2 results, and we are making an assumption that the requested rent is the rent that a tenant will end up signing for. So we can probably get between $1,350 to $1,500 for the 2-bedroom units. Now let's run that same filter for 1-bedroom units. In this case, there's only 1 result. Putting this all together, this property can rent for, at a minimum, $4,700 towards our $5,200 cost. Net operating cost. Now, if we assume that we live in one of the 2-bedroom units, then the rent would be $3,350, and we would be paying $1,850 ourselves. Remember, this is rounding against ourselves and worst case scenario. Remember earlier when I asked if the house works for you? Does $1,850 per month work as effective rent for you? How long do you plan to live there? You should probably only buy if you plan to own for at least 7 years. And for residential financing, which we're assuming here, you need to live there for at least a year, or at least intend to at the time that you sign the mortgage. American real estate has only ever gone up for the entirety of U.S. history. That doesn't mean you should assume there won't be a market crash immediately after you close, but probably if you hold long enough, say for 15 years, it'll eventually come back up. Can you hold for 15 years or more? These numbers also assume you manage the property yourself. If you pay a manager, they will typically take a 10% cut of the rent. In this case, that makes your monthly costs own more like $3,700, resulting in a net rent to you of $2,200 per month. Let's say that you need to get that back down to $1,800 for the property to work for you. Go back to your mortgage calculator and reduce the home price until your total monthly payment is down $500. Attaches a screenshot of my example. So in this example, you need to get your financed amount down to $445K by some combination of a lower offer price to the seller or making a down payment. I recommend the former more than the latter. This amount also means that the building's current total rent of $4,700 once you move out only has to cover a monthly expense of $4,700 per month, leaving you a net zero, although this can also prove profitable at times. While unforeseen repairs and vacancy will happen, all the rounding against ourselves is meant to compensate for that. However, you want to be fairly certain that the home's value and rent will go up over time. You should purchase based on what those things currently look like with some safety margin, but you don't want to buy an asset that you expect to decline over time. This is mostly driven by local population growth. So let's open another Google tab and search for the population growth of our zip code. We will be assuming that past trends continue, which of course they may not. The first result shows the population roughly halving over the past 20 years. This makes the area a hard hell no for me. And I would just rent and focus on investing in stocks if I did live here. Let's see if this trend is verified by a second source. So, over the past decade, the place began regrowing very slightly, but most of that trend started about 8 years ago. In other words, the place looks to be on a long-term decline with a very limited indication of the trend reversing. Since I'm a little ways into my investing journey, I might buy it if I get a really good deal, like $150K for this property, but otherwise this is a hell no for me. Never buying a place with population decline. However, let's continue through the process for education. And for anyone who's a first-time home buyer who just wants to be able to do reps on stuff like this, so you can make a more informed decision when you do buy. Hopefully, whatever property you're evaluating fares better. Assuming we made our $445K or less offer on the place, now we produce the 1.5% earnest money and hire an inspector. If you're local, you would want to at least visit before making an offer. The inspector should be looking for any tiny thing wrong. Big red flags I recommend you don't mess with are if load-bearing walls are unsafe or if the foundation has an issue. That's probably not worth messing with, so I'd ditch it immediately. Now, if there's more of a mid-size issue like a bad roof, or if the deck is unstable, or a non-load-bearing wall needs to be replaced, have a general contractor bid their price to fix the issue and ask the seller to either pay the cost or remove it from the offer price. When you visit in person yourself, what you should more so be thinking about is any immediate signs of the load-bearing issues. The roof having issues, termites, always check for termites yourself and with the inspector, and also things the inspector might not pay mind to. How wide are the stairways and doors? People should be able to move furniture, and in an old house, sometimes they can't. Does it feel crooked or cramped or old? This usually means the structure is warped or the insulation is trash. Are the bedrooms large enough for modern standards, or would a bed barely fit? If it's not a place you'd be fine living in at least some point in your life, then I wouldn't bother buying it. When I say some point, I'm saying, like, you could buy it as a rental and say, well, I wouldn't live here because I have a family now, but if when you were single you would be willing to live there, then that's fine. If the place just looks ugly, then you can use that to negotiate a small price reduction so you can pay for new paint, carpet, and such, which also tends to be the highest return on investment renovations that you can do. You should now use your realtor as a mediator to ask every little question you can think of. It's better to do this before you make an offer, but you can still do it at any time. Some examples include what are the homeowners association or cooperative dues? How much do you pay in taxes every month? You, in this case, being prospective seller. Why do you want to sell the property? What is the vacancy rate of your tenants? How long are their contracts? How much is their rent? Emotions. Some sellers are emotionally attached to their property. So, writing a personal letter that you would be happy to live in such a magnificent home and take good care of it for years to come can help in some cases. I did this with a large single family home once and beat a slightly higher deal as a result. I didn't actually end up buying the place because it had too much fire damage, but that's another story. In conclusion, I would not end up buying the sample property in this video unless I was able to get it extremely cheaply. Mostly because the local population is likely to continue declining in the coming years, and the price-to-rent ratio is mediocre at best. But hopefully, you can follow along with this video when considering a property, and that will help you make an informed decision and a wise offer. Like and subscribe if you hung out until the end despite my abysmal sound quality. Do you like my own voicing better than the voice actors I hire or the AI generated voices? There's actually been a couple videos where I use an AI tool to generate my own voice because that's faster than me recording. Also, I'm considering making a video on negotiating with lenders. If that would interest you, please say so in the comments and that will help me know what reductions to prioritize. You only have one life to live. Grow it relentlessly.